volatility is much in the news these days. Of course, it's always in the news. It seems every time there's a downdraft, the pessimists come out and tell us that the world's going to end, or there are 1,000 different reasons that are bad and we shouldn't own stocks. Well, I'm Greg Wellborn with First Financial Consulting here in Pasadena, California, and I'd like to tell you why I think you should own stocks. To do that, first of all, we need to define our terms. What is a stock? And some people, if you say stock, they think of a pig or a goat, a sheep, livestock. You buy it, you fatten it up, you sell it in the market. We're not advocating that. We're not talking about that, primarily because I'm concerned you might name the little piggy Charlotte or Webster or Wilson, and then you wouldn't want to sell it once it's fattened up. That would ruin that plan. No, what I'm talking about is owning a piece of a great company, like an Apple, a GM, a Ford, a Starbucks. That's what a stock is. It's simply a piece of paper that says you own a piece of one of the great companies, or maybe several of the great companies in America and around the world. That's different than a bond. We'll talk about that in another bench talk. A bond is essentially lending money to one of those great companies. No, stock is you own a piece of it. But what do you really own a piece of? I mean, I suppose we'll use Apple in our example. If you owned a bit of Apple, share of Apple, and you were able to get over the fence, drive into one of their facilities, you could look out at all the machines that are making those iPods and iPhones and Macs and say, I own some of this, and I want that machine loaded on my Ford F-150, and I'm going to take it and do my thing. Of course, that means you'd have to run the machine, buy the materials, then make the phones, then find the sales and the marketing, the distribution and all that. In other words, what you'd have to do is you'd have to use the machine to generate a profit. And that's what you own when you really own the stock, is you own the profit of that company. You own your share of it. And that's how the price is determined on the stock. That volatility we talked about, it's the volatility of the price of the share of stock. Now, let's use an example. We've been using Apple. We'll stay on Apple. Let's say Apple said to you they're willing to pay $8 a share of profits, and you want to earn 8%. Well, trust me on the math on this. You'd be willing to pay $100 for the Apple stock, because if you pay 100 and they give you 8, that's an 8% rate of return. Well, if the whole market, all the investors in the world agreed that 8% is what they want, the price of Apple stock would be $100. But let's say you got greedy. Let's say you said, no, I don't want an 8% rate of return. I want a 16% rate of return. Well, then you tell Apple, I'll buy your stock, but I'm only going to pay you $50 to do it. Again, trust me on the math. If you pay $50 and they pay you $8 in profit, that's a 16% rate of return. Well, if all the world agreed with you, all the investors out there said the same thing, the price of Apple stock would be $50. But if you're the only one saying that, Apple's not going to sell you the stock for $50. They're going to sell it to somebody else for $100. So the price of the stock gets determined by everyone competing for the profits that are there. Now, I wish it were that easy. That's the concept. But unfortunately, it's a little more complicated than that, because you and everyone else is not buying just today's profits. You want to buy today's and tomorrow's and the year after and the year after, et cetera, et cetera. Figuring out what those future profits are going to be takes a little more skill, a little more analysis, and there are books written on that, and there are analysts that do nothing but analyze to figure out what those future profits are going to be. But the concept's still the same. Today's profits, tomorrow's profits are what is being priced in the price of the stock. The other part of that, though, is just human emotion. We're never going to be able to take that out of the equation. There's always going to be fear and greed. Now, the last time that we saw that most clearly demonstrated was in 2008, 2009, when at the bottom, stocks collectively had dropped about 43% from their high. I had a lot of clients coming in and saying, oh my gosh, we should sell, we should get out, who wants to own stocks? And we answered those questions with two questions of our own. First, you've got friends, you've got family, you've got neighbors, acquaintances. Tell me, as you look around, do you really think that all these companies have lost 43% of their profits? You think that the economy has dropped 43%? And they, of course, said no. Second question we asked, well, what do you think that they've dropped? Most people said somewhere between 10, maybe 20%. And we kind of looked at them and said, if the stock price had been exactly perfectly priced, and was only off 10, 15, 20%, would we be having this conversation? And of course they said, well, no, we're having the conversation because it's off 43%, we're scared. That extra amount of drop-off was the fear in the market, and of course it came back. The point of this is that the volatility is just the volatility. It's going to be there. With all that said, I'm going to tell you that you need to own stocks because it is the most consistent way over the long term to get rich. And I don't use that term hyperbolically. I mean it sincerely. Most of us see some television show that says, oh, somebody's invented something great. We say, I wish I could have done that. That guy's going to be a gazillionaire. Why can't I think of that? Well, we don't have to, because there are a bunch of companies out there, again, the Apples of the world, Microsoft, GMs, are thinking of great stuff all the time. We don't need to be the inventor. We just need to own a piece of one or some of those great companies. Put up with the volatility. Recognize that the profits collectively of those companies have been remarkably consistent over the long term, not the short term, but over the long term. So if you want to get rich, if you want to accomplish your financial goals over the long term, this isn't get rich quick, but over the long term, you need to own a piece of all those great companies. We'll talk about diversification, how many stocks, which stocks, in another bench talk. But for right now, the reason you want to own stocks is because that's one of the best ways to accomplish your financial goals. Thanks for listening.